Good evening to one and all. It's my pleasure to welcome you all for the live virtual webinar on COVID-19 issues in Companies Act accounts on audit led by CA Gururaj Acharya from Bangalore. I welcome Speaker of the Day, CA K. Gururaj Acharya, Management Committee member of Pondicherry and Madurai branch of SARC of ICI, our fellow members and the invitees. Instruction regarding the YouTube meetings. We request all the members to ask the queries by clicking the comment button, and the queries will be taken up only during the question and answer session, which is likely to be done at the end. We also planned for another live virtual webinar, which was led by CS Sriram on overview of FEMA regulations on foreign direct investment in India. So kindly subscribe our YouTube channel and also click the bell icon to get the regular notifications. I wish the members will enjoy today's session and make it a grand success. I request the Madurai branch chairperson to give her address.
Thank you, Kritika. Good evening, members. On behalf of Madurai branch, I welcome all the members of Madurai branch and Pondicherry branch and our today's speaker, CA Gururaj Acharya sir. Welcome, sir. Pondicherry branch chairperson Kritika is a good friend of mine. In fact, this is the first time Madurai branch is conducting joint program with Pondicherry branch. Since Pondicherry is very far from the Madurai, so it is not practically possible to conduct physical CP meeting. So this kind of technology like you.
I think some connectivity problem with her.
Yes.
Yes.
Audio is not.
Yeah.
Yeah, you can.
Yeah, it's over to you, sir.
Yeah.
You can start your session, sir.
You're able to see?
Yeah, but I didn't get the PPT, sir.
You're able to see now?
Yes, sir.
Good evening to all of you. Indeed, my pleasure to be virtually present in Pondicherry and Madurai simultaneously. This is possible only with the help of technology. Although Corona is the pandemic which we are unfortunately facing with, but the real pandemic, I am told today, is actually the webinar itself. Be it as it may, let me tell you that Section 149, subsection 1 of the Companies Act talks about a very interesting phenomenon where it wants every class company to have at least one women director. Why did I take up this in the beginning? Is to just say that I am so happy to have two women chairperson of these two powerful branches led by women. Both Pondicherry and Madurai have got women chartered accountants as the head of the branch. And I'm also told that it is not only in these two places, in 8 branches in South India today, this year, we have women-led women-led chairpersons. Section 149, subsection 1 makes it mandatory for every listed company and for every public company which has a paid up capital of 100 crores and a turnover of 300 crores should have compulsorily a one women director. But here we have both the branches led by women, Kritika and Abhinay. I'm so happy to be with you today. So my topic is issues in Companies Act, accounts and audit, especially during the lockdown. There are a lot of notifications, circulars, etc., which have been announced. So I will be taking you through the various issues that arises out of. First of all, I will tell you what are those various circulars, notifications which have come out, and then what could be the various issues that we could face in the Companies Act during the accounts and during the audit season, when we actually prepare the accounts around for the financial years. In fact, I was in Madurai. I was fortunate to be in Madurai in 2015. And just last year, I was in Pondicherry. I remember the date, 10th of August, when the sub-regional conference happened in Pondicherry. I was there talking on Companies Act. So maybe 4 and 3, 7 months down the line, I am there again, virtually although. So let me take you on through my session proper. And before I get into the session proper, let me I would lay the background for this particular session. All of us are aware that we are in a very extraordinary situation of COVID-19. What does COVID-19 stand for? It is a abbreviation for the word Coronavirus Disease 2019. One may have this abbreviation, but another friend of mine corrected me to say there is another abbreviation, another full form for this abbreviation. COVID stands for Corona Originated Virus. China originated virus. This is China originated virus in December 2019. So Corona was originated in China. So therefore, China originated virus in December 2019. Now there are two views possible on this. One of them, a few of them are saying that it was actually a created virus in the laboratory. I would not like to get into that without a basis. But one thing which China is responsible for is probably if they had warned us enough, because this happened there in December itself, and December and January it was picking up in the month of February. If only they had warned us, if they had warned the rest of the world about the way the virus was spreading out, maybe the other countries could have taken care of, and we could have had a better approach to this rather than what we are going through. Corona is unfortunately an invisible enemy which all of us have to fight. How do we fight? And the result of the corona has come on account of the result of globalization. This is the unfortunately globalization led to enormous amount of economic growth. But today the problem that we are facing is also on account of globalization. But the fight against it, the fight against corona has to be absolutely local. In fact, it has to be when there are certain wards in Bangalore which have been closed. We are not allowed inside the particular ward, and people from that ward cannot enter. So it is so much of a local solution that maybe staying back in the house itself is the best way to solve it rather than going out and mingling with people. A couple of years ago, I was asked to talk on a very important topic called compliance management in VUCA world. Now, what is this VUCA? VUCA is one of the terminologies which was coined during the Second World War by the army people, the full form of which stands like volatility, uncertainty, complexity, and ambiguity. In fact, 2 years ago, when I said that it was we are living in a VUCA world, maybe now I realize that VUCA was very, very mild. But today, the VUCA world in which we are is the real VUCA world. What can be more volatile than the stock market? If you see today, the peak of almost 42,000, the Sensex had reached 42,000, and today it is hovering around 31,000. In fact, it had touched a low of 27,000 points also. What can be more uncertain than, in fact, Madurai Secretary, Mr. Mohan Sundaram, was asking me, when do you think the situation will come down to normalcy? When do you think the situation will come down to normalcy? It is, in fact, anybody's guess. All of us have to just guess as to when things can come back to normalcy. We are not sure whether the lockdown will be opened up on 4th of May. At least in Bangalore, we are more or less making a provision for, as chartered accountants, we are very conservative. We provide for the lockdown not being open at least until 19th of May. In fact, another 15 days from 4th also it could get extended. So we don't know when the situation will reach its normalcy. Forget about when the lockdown itself will be open. And then we have a highly complex environment, the complexity with respect to whether we need to pay salaries to our employees. If we pay salaries to our employees, how much do we pay? Do we pay them in full? Do we pay a part of it now and part later. Now, there are a lot of complex decisions which business people will have to take. And finally, we are also living in a very ambiguity, in a great amount of ambiguity. I would explain ambiguity for accountants in a different way, that if, let us say, the goods have moved out of the factory on 20th of March, when the lockdown was not there, and has got stuck up. I mean, I have already invoiced for the goods. It has reached the port. I mean, it was an export of material. It had to go to, let us say, America, and I have sent my goods from Pondicherry to the port, and the goods have still not been shipped. The lockdown was announced, and the goods could not be shipped. On 31st of March, the goods were still lying at the port. Now, the ambiguity for the accountant is, should he account for this, let us say, dispatch of material of worth 5 crore rupees during financial year 1920, or should he defer it to 2021? So there could be ambiguity. Although I have already made an invoice, paid the GST wherever, if it could be a local dispatch of material, I could have paid the GST also, but the material has not reached the customer. So do I take the turnover in financial year 1920, or do I take it in 2021? An ambiguity there. So we'll talk about all this during our session. But before that, let me also set the things in perspective. Government was in a great amount of dilemma when this particular matter had to be debated, to save the lives or to save the livelihood. I think they went in for taking a very crucial decision of saving the lives at the cost of probably the economy. So the livelihood is today taken a back seat, but saving life has become the most important aspect for the government. What are the various measures that they have taken apart from saving the lives? Is they have invoked one of the very dormant act, I may call it as a very dormant act, which we had hardly seen in our lives, called the Epidemic Diseases Act 1897. There was an Epidemic Diseases Act of 1897 which they invoked, along with another act called the Disaster Management Act of 2005. By invoking these two acts, the government took upon itself the right to ask the people to go inside their house, not to open their shops, stay indoors, not to come on the road. So they said that complete lockdown. At least in Bangalore, we were closed on, I'm sure even Pondicherry and Madurai were closed on 22nd, that was a Sunday. And 2 more days, Bangalore, 23rd and 24th, we were closed. And 24th evening, our Honorable Prime Minister came on television to announce that we are having a lockdown for 21 days. And later on, again, he said that we are closed for another 19 days. That way, we are sure that we have been closed for 43 days for sure by invoking these two acts. And then one of the important points that is to be noted is this one COVID positive person can infect about 406 people if he is not under lockdown, if he is not limited. But with a proper social distance, he can infect only 2.5 people. In spite of proper social distancing, it is so dangerous that it can still infect 2.5 persons. Wuhan, where this particular virus was originated, it was locked down for 76 days. Now here I have to pause and tell something for the chartered accountants, that we chartered accountants are attuned, or we are good at lockdown, because when I'm sure that all of you, when we were preparing for our CA final or CA exams, we had locked down ourselves. At least myself, I had locked down myself for 137 days. I was reading in a hotel, and I went into the hotel in the month of November, I'm talking of 1991, and I came out of the hotel in the month of April 1992. Approximately 4 or 5 months, I was inside the hotel, not coming out of the hotel at all. That was the preparation I was doing for CA final. I'm sure all of you have the same stories to share. And also during our season, during the tax audit season and finalization of the account season, we are all locked inside the offices for a good number of times. So for us, chartered accountants, we are already used to being inside the house and not coming out in the open. So for us, this would not disturb us as much. And even today, when actual lockdown is happening, there are so many circulars and so many notifications, so many ordinances that are coming out. We are busy reading it. And in fact, I am at least more busy than I was during the normal time. What are the various interim reliefs that the government has already given? They came out with the finance minister came out with some packages initially as a press release, and later on they have come out with an ordinance. Like the full form of the act which came out was the taxation and other laws, relaxation of certain provisions, ordinance 2020, dated 31st of March 2020. On 31st of March, there was a special ordinance which was issued. What is an ordinance? Normally, when the parliament passes a bill, it has to go through the Rajya Sabha, the Lok Sabha, the Rajya Sabha, and then gets the assent of the president, then becomes an act. But when the parliament is not sitting and the matter has to be immediately become a law, they come out with an ordinance, and they came out with an ordinance in such an extraordinary situation to deal with matters on income tax, GST, customs, and indirect taxes. Time permitting, I will talk about what they are a bit later. But definitely, there were a lot of changes which happened in the Companies Act, Insolvency and Bankruptcy Code, and the Financial Services. Changes were also made to the banking rules, I would say. They have provided banking reliefs, especially in terms of extending the moratorium of the term loans by 3 months, deferring the interest payment on the working capital by 3 months. They have told that the banks can park the interest which is applied for the 3 months period from April, May, June to a separate account and not affecting the drawing power. So they have come out with a lot of reliefs. They have reduced the repo rates and the reverse repo rate. And they've also done a lot of measures they have taken to enhance the liquidity measures in the economy, by virtue of which the funds can flow from the Reserve Bank of India to the bank, from the bank to the borrowers. So a lot of measures have been taken. And a lot of stimulus measures, economic package, especially for the Garib Kalyan, that is the people who are poor, for them to alleviate the poverty. The finance minister has come out and given about 1,70,000 crores worth of economic package to the economically backward. And one of the statements which was made by the Vice President of India, which sets the tone for the government's thinking, is that he said, the concern of the economy can wait for another day. Those of the health cannot. That means if there is a proper health, if there is life, there is economy. What do you do with a good economy if the health is not there? So that is what it is meant by the statement there. Therefore, the government has gone in to save the lives, probably putting the livelihood in a back burner. Let me tell you one thing that the finance minister, all of us know, presented the budget 2020 on 1st of February. This budget was having an outlay of about 30,42,000 crores. 30,42,000 crores was the total outlay of the budget. And the inflow coming in from various tax measures, disinvestment, etc., was to the tune of about 22 lakh crore. 22 lakh crore. The balance being the fiscal deficit. In fact, out of 30,42,000 crores of outlay, there is an inflow of about 22 lakh crore, making the deficit of 7,96,000 crores. This is a very shocking figure there. When we read the newspapers, we read the deficit as 3.5%. In fact, what is this 3.5%? 3.5% is a percentage in relation to GDP. As chartered accountants, we know whenever we talk about an inflow and outflow, the percentage of deficit has to be in relation to the outflow. In fact, if we have to say the deficit is to the tune of about 27% of the outlay. The total budget outlay is 30,42,000 crores. 7,96,000 crores makes it about 27, more than 25% of the total outflow is the deficit. But what do they say? 3.5%. 3.5% of this deficit in relation to the GDP. India's GDP is to the tune of about $2.7 trillion, which roughly works out to about 220 lakh crore. So 220 lakh crore versus 7,96,000 crores of fiscal deficit makes it 3.5%. But why am I telling all this? Just to tell you, friends, that we can't expect too much from the Indian government because they're already in a huge deficit. For 30 lakh crore outflow, they have a 22 lakh crore of inflow. Within this 22 lakh crore of inflow, let me tell you, 11 lakh crores come from income tax and corporation tax. About 5.5 lakh crores comes from GST. The balance comes from this investment and so many other places. The deficit itself being financed by the borrowings to the government. So this year is a very difficult year for the government. This 30 lakh outlay of funds will definitely go up because of additional stimulus packages given, etc. Whereas the inflow of 22 lakh crore will not be to that extent. It will certainly be lower. Thereby, the fiscal deficit will be more than what was originally budgeted. That is why I have a gut feeling that the government will have to present a version 2 budget, of for the financial year 2021. This is a very interesting slide which shows that India is not a country consisting of so many states. India is a country consisting of so many countries. In fact, I can see that Karnataka is equal to the size of Italy. Tamil Nadu, from where Pondicherry, Madurai lies, is the size of Turkey. At least I know that Italy, Karnataka, if I have to make a comparison, in fact, United States, unfortunately, is leading the chart with 10,000 cases of corona patients, affected positive turn patients. Italy has about 1,99,414 cases. China, I don't know whether it is true, but the statistics say it is stuck up at 82,000 cases. India is unfortunately was very low at the time the lockdown was announced. It is about 29,000 cases. Karnataka is 512. We should have put up how much is it for Tamil Nadu, but at least I can say one thing, that Madurai has got 79 cases shockingly, and Pondicherry has got only 8 cases. Why I took up this particular slide is to tell you that if you compare Karnataka with Italy, then we have to compare not 1,99,000 cases, not India's 29,000 with 1,99,000 cases. We have to compare 1,99,000 cases of Italy with 512 cases of Karnataka. So that way, India is doing very well. So let us continue to do well. Otherwise, this particular chart is like a Olympics medal chart, where United States always leads, and India is always at the bottom. For a change, I think we are very happy to be at the bottom of the tally chart. Why does such a situation happen? Unfortunately, the entire economy is more towards fashion, more towards paying money towards entertainers. In fact, the payment which we pay to Virat Kohli, the payment which we make to Sachin Tendulkar, or the football players, is so high, and the doctors who are actually the people who really work with the brain, the researchers and the doctors, are paid a pittance. For that matter, even chartered accountants are paid a pittance in that sense. I'm talking about our own profession. But the point I'm saying is, if at all we had taken care of people who are actually contributing to the economy, we would not have faced a situation like this. A wonderful message given by this Spanish biological researcher: you give the footballer 1 million euros a month, and a biological researcher 1,800 euros. You are looking for a treatment now. Go to Ronaldo or Messi, and they will find you a cure. What a beautiful statement made there. Let me talk about the economy and the financials. All of us are in a very tough situation. Earlier, we used to call anything which happened in the society, in the social studies, if we have to talk about, we used to talk about before BC and AD. BC standing for before Common Era, and AD standing for Anno Domini. So we used to have that as a cutoff. Whereas now, with the corona coming in, the situation will be the impact will be so much that we may have to talk about before corona and after corona. The new terminology will be whether we were in a BC environment or an AC environment. And right now, what we are, the moment where we are, is called during corona. And within corona period, we have something called the lockdown period and after lockdown period. And there is every possibility of a multiple lockdown happening. In case the situation does not come under control, the lockdown could be announced, the lockdown could be opened up on 4th of May, but then maybe after a week, if the numbers go up, there could be multiple lockdowns possible. So all of us in the financial statements, we have one very interesting terminology called the operating profit. What is the operating profit? Earning before interest, taxes, depreciation, and amortization. But this year, but from the financial statements that we will be seeing from after Corona times, we have seen a lot of circulations coming in the WhatsApp as a joke, saying that earning before interest, taxes, depreciation, amortization, and the coronavirus. While this may look like it is a joke, but actually in the financial statements, we have to bring out this particular line item to say that before the extraordinary situation of coronavirus, my profit was so and so, and it got wiped out because of the extraordinary expenditures that I have to incur, and therefore my profit after Corona situation, profit before Corona situation, for the sake of comparing with the BC environment. Let me also tell you one thing, friends, that a lot of people were expecting that the financial year itself will undergo a change. But there is no extension of financial year. The financial year will continue from April to March. There will be no extension whatsoever. There was a doubt when a news item came that Reserve Bank of India is going to have its year end on 30th of June. I mean, that is the time when the newspapers and the televisions went on to say that the financial year got extended to 30th June instead of 31st of March. Here I have to pause and tell you that Reserve Bank of India was always following the July to June as it's a financial year. Somewhere in the month of February, Reserve Bank of India, I don't know why of all the years they took up this year itself, they decided, the board of Reserve Bank of India decided that they want to follow a financial year model. That means they want to follow the April to March financial year model like all of us. But then again in March, when this lockdown happened, they felt that they would like to go back to their earlier version of following the July to June financial year. So that is how this particular, they came out with a statement saying that we are going to follow the June year ending as our financial year ending. That was the news item which came out. They were always following the July to June financial year. And now, when this news item came, the people who did not understand this, they said that the financial year got extended. But let me tell you, the financial year is certainly not extended for any one of us. Next, let me ask you a question before I get into the issues in the financial statement. Is the following statement correct? The major impact of COVID on business, COVID or lockdown on business, is felt after April 2020. Because March 20 up to March 21st, things were looking okay because the turnovers, the financials, etc., were happening in the normal manner. So the major impact is felt after April 2020. So the financial statements of 1920 will not be impacted much. So this is a very important question. I want all of you to think, all of the people who are seeing this particular program to think for a while. Is it true to say that the financial year 1920 will not be impacted as much? Rather, the major impact will happen in the financial year 2021. So to put it the other way, only 10 days out of 365 days, because even if you take that from 22nd of March to 31st of March, we had a problem. So that would be approximately 10 days in the financial year. So in financial year 1920, 10 divided by 365 days, it was the virus got impacted. So therefore, the impact is only 10 divided by 365. And the major impact will happen in the financial year 1920. The next financial year 2021. Is it right? I want all of you to think. And in the meantime, I'll have a sip of water and then I'll come to the answer. The answer for this, my friends, is that it is absolutely wrong to make a statement like this. Although the financial year 1920 had only 10 days impact, we accountants have a very important concept called prudence. What is prudence? When we know that we are going to incur a loss, that loss has to be accounted for in the statement in which the financial statements are still not completed. That means although the impact happens in the month of April or May, the impact of this will have to be provided for in the financial statement 1920. So let me finish off the accounting issues first. And very beautifully, what I've done is summarize the entire accounting impact through the accounting standards itself. Yeah? So let's see what are all the things in the financial statements of 1920. I'm not even talking about 2021. 2021 financial statements will have an impact, but that impact will have to be noticed when we are drawing out the financial statement later on. Right now, the financial statement of 1920, which is not yet ready, it will have a huge impact. So what could be the huge impact in financial year 1920? There could be, going by accounting standard 1, the disclosure of accounting policy. Although this standard talks about the disclosure of accounting policy, there they say that the going concern is a fundamental accounting assumption. Now, if that assumption is good, then you don't have to do anything. It is assumed. But if that going concern of an entity, if a business entity is impaired, that means if there is a problem with the going concern. What is the going concern problem? If the entity is not going to run as such within the next 12 months from the balance sheet date, then the balance sheet which I am preparing should be not prepared in the normal historical cost basis. I will have to restate the entire financial into a realizable basis, bring down all the assets and liabilities into realizable assets and payable liability. I have to bring it down into realizable values. The land and building which I'm carrying in my balance sheet has to be brought down to its realizable value instead of cost, less depreciation, less impairment. So I will have to find out whether the going concern is impacted and make a drawing of the financial statements of 1920 if the going concern is affected accordingly. Then we will have audit issues, which I will talk a bit later on. Then what about valuation of inventory? Now look at this. The valuation of inventory on 31st of March, there could be some value, but then the value would have greatly dropped in the month of April, May. The same inventory, which was, let us put it like this, I will give you two scenarios. Let us say I have oil as valued at 50 rupees a liter as my balance sheet value. And in the month of April, let us say the value of oil per liter dropped down to, let us say, 30 rupees. Now, do I keep this value as on 31st March at 50 rupees or 30 rupees? The inventory standard, accounting standard 2 says that inventory has to be valued at cost or net realizable value, whichever is lower. The net realizable value as on what date? The date it is expected to realize. So events occurring after the balance sheet date also has to be considered for the purpose of valuing the 31st March figure. So in this case, although on 31st of March it had a value of 50 rupees, I may have to bring it down to 30 rupees being its value. At least we have certain cases where breweries, where they had about 50,000 liters of, let us say, liquor in their barrel on 31st of March, which was valued at, let us say, 50 lakh rupees. But on 15th of April, because we know that this particular liquor in the barrel has a life of about 25 days. Now, since on 15th of April, the 25 days life got over and the liquor inside the barrel got expired. So they had to open the tap, drain it out to the drainage. The entire liquor had to be drained out inside to the drainage. So how do I value that inventory now? On 31st of March, it was worth 50 lakhs. On 15th of April, I have drained it out completely. So I will have to value on 31st of March, not at 50 lakhs, but at zero value. So look at the situation which arises, an extraordinary situation. Cash flow statement, accounting standard 3 talks about operating activity, investment activity, financing activity. All these activity would have come down to a standstill. Operating activity would have come to a reduced activity. Investment activity not much, so therefore both these could have been negative, and mostly it would have come by financing activity. So thereby cash flow statement could be a collateral damage. Contingencies and events occurring after the balance sheet date. There could be a lot of events happening after the balance sheet date, which has to be taken into account for the purpose of making adjustments, because some events occurring after the balance sheet are only disclosure issues, some are adjusting issues. So we may have to consider, if it is an adjusting issue, to provide for that in the financial year 1920 itself. Accounting standard 5, net profit or loss for the period, prior period items and changes in accounting policy. Very important. This is where we have the extraordinary and exceptional items. I mean, I have to pause here and say that there could be lot of items when we talked about before Corona, when we talked about earning before interest, taxes, depreciation, amortization, and Corona. Actually, this Corona is what, before Corona is what gets captured in the extraordinary line item. Now, what could be the various extraordinary items which could come? Let us say, if I have written off lot of bad debts on account of some of our customers going concern being impacted. I mean, I had a receivable of 2 crores and that particular customer had gone bust because of this particular lockdown situation. Now, this 2 crores, I have to write it off as a bad debt. I would bring it as an extraordinary item because in the normal situation, this particular bad debt would not have arisen. There could be impairments. There could be also a very interesting situation where the salaries, it could be a fixed expenditure in the normal situation, salaries which I pay to my employees, can I bring it under extraordinary item? There could be two views possible. One of the view is to say that all fixed costs cannot be coming as a extraordinary item, but there could be another view. Let me tell you that if a company has a salary of about 12 crores per annum, 12 crores per annum. Now I'm talking of the financial year 2021, financial year 2021, 12 crores, and I have paid, let us say, 2 months salary without there being any revenue into my P&L account. There was no revenue happening, but 2 months salary of 2 crores I have paid without there being any activity in the company. Now, in the normal situation, if the employee had actually applied for leave and I was working, maybe I would not have paid him salary, or he would have adjusted against his leave. Now, in this situation, I'm not adjusting against his leave. Rather, I'm paying the employee full salary without deducting, without getting any benefit in return. So therefore, I will consider this 2 crores as an extraordinary item. I will put the salaries for the last year as 12 crore, next year as 12 crore, but for this year, financial year 2021, I will put the salary as 10 crores, and the 2 crores which I paid during the lockdown period, I will put it under the extraordinary item for the sake of comparison in future, because my profits were dropped. If I have to see what was my profit before extraordinary item, I would not take this 2 crores as an expenditure at all. It would be added, I mean, it would not be considered as a expenditure when I put it under extraordinary item and I test operating profit at that level. So there could be a lot of such items which I have to put it under extraordinary items and exceptional items, and there could be disclosures galore. Construction contracts, there may be a lot of impact, but I don't see a direct impact there on the financials, that is. Revenue recognition. Now, in the beginning, I went on to say that revenue, we will have a problem with the goods which I have dispatched on 20th of March, but not reached my customer on 31st. On 31st, it is still lying with the port. Now, do I recognize this revenue? 5 crores of material which has gone out of my godown, reached the port, but has not reached the customer. I have already invoiced it. Now, how do I look at it as an auditor? Do I take that revenue as a revenue? In the normal situation, I would have taken it as a revenue. But in this situation, if the goods has not moved, then what does the accounting standard 9 say? The revenue has to be recognized only when the risk and reward in the goods has got transferred to the user of the asset. Now, has got transferred to the customer in this particular situation. Has it got transferred? Now, the question that I would ask is, if it is lying with this at the stockyard and the customer has still not got the risk and reward, then although I have drawn out this 5 crores of invoice, paid the GST if at all, then there is no way. I will have to reverse it. I will have to reverse it and take it as a turnover for next year. Similarly, I will have to have a situation where the turnover is done, the goods has reached the customer, but the moment if he has got bust, he is not in a position to pay me, then because of the uncertainty of collection, I will have to postpone my revenue recognition. There could be a lot of disclosures on account of revenue recognition. One very incidental issue, let me tell you, some of our clients have faced. This is, we had estimated that the turnover would be 100 crores for the financial year 1920, and we have paid the advance tax for 15th of March. On 15th of March, when we paid the advance tax, we were estimating that the turnover would be 100 crores. But from 15th to 31st, the turnover could not happen because I could not dispatch, or situations like this, just now what I explained, 20 crores I could not do. So I had estimated my turnover at 100 crores, estimated my profit and loss account, paid my advance tax to the extent of 100 crores. But in reality, my turnover was only 80 crores, 20 crores of goods which were lying in the port, I could not dispatch. Let us say on this 20 crores, I had estimated a profit of, let us say 10 crores, and therefore the tax would come to 3 crores. So I had paid an extra income tax of 3 crores for the financial year 1920. When I actually draw out my financial year 1920, my estimated turnover was 100, my actual turnover was 80. My estimated income tax was, let us say, 33 crores. My actual income tax, when I draw out my 80 crores turnover, would come to only 30 crores. So I will be left out with a refund of 3 crores from the income tax department. So what? But the problem is, next year, the moment the lockdown opens, assuming that the lockdown opens on 4th of May, and now I'm able to sell these goods which were in stock. 20 crores turnover, maybe when it comes to costing, stock will come to, let us say, 15 crores. I'm just putting it that way. Whatever cost or net realizable value, whichever is less. So it will be lying as stock. Next year in 2021, when I'm actually moving out the goods from my godown or from the stockyard, this 20 crores will sit as a turnover of the next year. So immediately on June 15th, I have to pay advance tax for this. Now look at my problem. This is a very typical situation where I have already paid the advance tax, and in income tax, unfortunately, every year is a compartment. That compartment, that particular assessment year's advance tax, I cannot adjust it against the next year. Next year, I will have to again pay the advance tax, leading to double whammy in that sense. So therefore, I have made a representation to the income tax department, and also made it through the CBDT and the institute. When it asked for suggestion, I made a suggestion saying that this year should be considered as an exception, and the government should come out with a option to the taxpayer to opt for advance tax surplus paid in financial year 1920 to be adjusted against the advance tax payable for the financial year 2021. Just like TDS, in a TDS rule 37BA of the income tax rules says that TDS can be carried forward to the subsequent financial years, subsequent assessment years, when the income of that particular TDS is reckoned. You can take like that. So in the similar manner, I have made a representation. I'm sure a lot of your clients also will have similar problems where you have paid surplus advance tax, waiting for refund. This refund I will be eligible to get after 2 years, after I finalize my income tax return, financial statements, income tax return, and claim for it. But whereas I have to pay this in the next financial year, leading to liquidity problems. To come out of this suggestion would help. I wish the government comes out with this particular change for this extraordinary situation. Property, plant and equipment, intangible assets and impairments, all of them I put it under one. Interestingly, during this particular season, we hear in the newspaper a lot of news on PPE. What is PPE in the newspaper? What we hear in PPE is personal protection equipment for the doctors. I mean, that is the PPE that they are talking there. But what we need to understand now for our purpose is property, plant and equipment. Depreciation accounting standard 6 today is removed from that standard and brought in accounting standard 10 itself, where they said that depreciation during the lockdown cannot be suspended. It has to be continued. Although the assets are not used, the assets get depreciated not only on account of usage, but also on account of effects of time. So you cannot say I will not charge depreciation. Accordingly, depreciation and amortizations have to continue. The second issue is Will there be a change in the useful life and a residual life? Quite possible. Because you have not used the assets for this period, maybe the useful life could get extended. The residual life could, the residual value could get extended. So that we may have to make a necessary change and change as an accounting estimate. There could be a situation where there could be tremendous amount of impairments. What is impairment? The carrying value, the book value of the asset, when compared to the recoverable value, if it is higher, if the carrying value is higher and the book value is lower, the difference will have to be knocked off as impairment. Accounting standard 28 says that what is net recoverable value? Net recoverable value is the higher of value in use or the net selling price. What is that you get if you sell the asset today and you compare that is if the asset is continued to be used, what is that you get in the value in use? So you have estimate the recoverable value, bring it down to the discounted figure today, net present value, that becomes the net recoverable value. If net recoverable value is higher than the book value, then there is no problem. But if the net recoverable value reduces and in comparison with your book value, the difference has to be provided as impairment in your books. The COVID situation, the lockdown situation impacts the economy so much that there could be a trigger of impairment of most of your property, plant and equipment. The test has to be done. That is what is important here. Accounting standard 11, the effects of changes in forex rates. We could see lot of changes, lot of forex losses, especially for those importers. For exporters, it will be a good situation, but exports may not have happened. But imports, yes, you are carrying a liability in your books. So those which were taken at 70 rupees, 72 rupees, if the rupee is touching 77 rupees to a dollar, you will have 5 rupees to a dollar as losses. All those losses will have to be provided. Government grant, a very interesting situation with respect to government grant. If at all the government is giving you any subsidy, it has to be accounted as gone under the accounting standard 12 government grants. What are the subsidies that is right now given to the business? For the moment, one subsidy which I can think of is the government has told, in the case of a business entity, I will contribute the PF. I will contribute the PF contribution. The government will contribute the PF contribution of both the employers 12% and the employees 12% for the month of April, May, and June. Whatever has to be paid for April, May, and June, the government is going to pay. For all those entities, they have put certain conditions. The entities, if the total number of employees is less than 100, if the employees are more than 100, government is not going to pay. If the number is less than 100, government is going to pay. They have put a second condition. The second condition is they have told that not more than 90% of such employees should be drawing more than 15,000 rupees. So that means up a maximum of the 15,000 rupees is the cutoff. 15,000 rupees, less than 15,000 rupees should be more than 90% of those 100 employees. So that is a very big catch there. Assuming that your entity has got, let us say, 80 employees, and in that 75 employees are drawing less than 15,000 rupees, then you are eligible for this particular subsidy of provident fund being paid by the government 12% for the month of April, May, and June. Whatever payment has to happen in the month of April, May, and June, the government pays for it. Now, let me tell you how does it happen in accounting. Let us say typically an employee's salary is, let us say, 15,000 rupees. He's at the cutoff. 15,000 rupees is the salary, and I am actually paying him PF of 1,000 rupees, and the employee is paying his 1,000 rupees. And let us say 12% of 15,000 for our purpose comes to 1,000 rupees. So how does it happen in normal situation? I will be paying 16,000 rupees. But when it goes to the employee, he will receive only 14,000 rupees. And 2,000 rupees, 1,000 rupees from my side and 1,000 rupees deducted from his salary will go and get credited to his PF account. So this is how the normal accounting happens. So I will be debiting to my profit and loss account 16,000 rupees as the employee cost. In this year, in the same entity, I will be debiting 16,000 rupees only, because for my purpose, I have paid him 16,000 rupees, but I will be receiving 1,000 rupees from the government. So I will be receiving 1,000 rupees from although the government is giving 2,000 rupees into the employee's account of PF, employer's contribution is actually met by the government. So to the extent of employer's contribution, my contribution, company's contribution, I will take the 1,000 rupees as a credit to my profit and loss account. So what will be my entry? My entry will be 16,000 rupees debit, and credit will be 1,000 rupees received from government grant. Now, government has given 2,000 rupees. Employee in this case will receive full 15,000 rupees. The government subsidy of 1,000 rupees, 2,000 rupees government has given, 1,000 rupees is to the employer, 1,000 rupees is to the employee. So that makes it a total. So whatever the government has given 2,000 rupees, I will be accounting my portion of whatever I would have paid as a credit to my profit and loss account to the extent of 1,000 rupees. So 16,000 rupees debit, 1,000 rupees credit. Questions that come out is, what is the impact of that in income tax? In income tax, this 1,000 rupees credited will form part of your profit, so therefore it could get taxed. Actually, it is going to nullify, and that's how it happens. But what is its impact on GST? In GST, any amount which is received from the government is not subject to the definition of supply and consideration, is excluding the amount which is received from the government. So therefore, there will be no GST impact on that. Next, accounting standard 13, accounting for investments. Stock market has gone mad. What was in one of our clients who had invested 25 crores in the stock market in the month of August, on 31st of March, he comes to me and tells me my 25 crores worth of investment has come down to 10 crore rupees. It's dropped to the extent of 15 crores. Now, do I book it as a loss? Now, that depends on accounting standard 13, whether this particular investment in the books is carried as has been carried as long-term investment or current investment. If it is a current investment, just like inventory, I will value current investment as cost or fair value, whichever is lower. Fair value as on 31st March, whichever is lower. If I value it as long-term investments, I will have to value it at always at cost. Long-term investment has to be valued always at cost, unless I will account for the drop in the value if that drop happens to be for reasons other than temporary. Now, it becomes very difficult for us to, as accountants, to know whether so it is very easy for us to value a current investment. To value a long-term investment, it could become that much more difficult because we don't know. There is a drop for sure, but how do we say that this drop is temporary or for reasons other than temporary? In fact, the standard is very, very clear. I always keep telling this. The standard does not use the word, the drop in the value of investment being permanent. The word they use is other than temporary. What is this other than temporary? Is it equivalent to permanent? Let me tell you, temporary, other than temporary, and permanent. So there is a difference between temporary and permanent, other than temporary and permanent. Other than temporary is a situation reaching faster than permanent. So one has to make a judgmental call whether I have to provide for the reduction in the value of this long-term investment. So a great amount of judgment is involved. Accounting standard 14 on amalgamation. I can only tell you, mergers and amalgamation, the valuations would drop a great amount. So goodwill accounting and impairment and all those things could be a big challenge there. Consolidated financial statement, accounting for investments in associates, joint venture reporting. I mean, there could be impacts, but I don't put it direct. One has to visualize those. Employee benefits. Employee benefits, there could be lot of changes in the actuarial valuation. The actuary, when he gives you the value of the employee benefit that has to be paid for future, it could be gratuity, it could be defined contribution, defined benefit plans, especially the defined benefit plans. He does lot of calculations and comes out and tells me this is the value of liability that you will incur, and so therefore based on the liability out of the previous liability, this incremental liability, the differential is what I will go and charge as expense for the year. But this year, the liability, the actuarial liability will change because of lot of actuarial assumption changes. There could be a lot of employee retrenchment. Employee turnover would change. The rate of growth of salary which we had presumed would actually drop down. The mortality rate in India, we normally assume that 71 years is the mortality rate. In fact, 3 years ago, the mortality rate went up from 69 years to 71 years. No wonder if that comes back to 69 years. So in that context, the actuarial valuation, actuarial assumptions could change, because of which the entire calculations could change. Maybe because of which the employee benefit, which I need to debit to my profit and loss account, could come lower than what it used to be there earlier. Borrowing cost. In fact, we have one very interesting concept in, what does Accounting Standard 16 say? This anything, when a qualifying asset, when I am constructing a qualifying asset, what is a qualifying asset? An asset which takes more than 1 year time for its construction is a qualifying asset. Now, if I have any borrowings in connection with that particular construction, the interest, the borrowing cost which I incur on that particular borrowing cannot be debited to my profit and loss account. It has to be capitalized. All other borrowing cost has to be expensed. Normally, Accounting Standard 16 says all borrowing cost has to be expensed unless it is in connection with the construction of a qualifying asset. Then you can capitalize it. And the standard also says when you should stop capitalization, when you should cease capitalization, when you should suspend the capitalization. One of the situations which is told is if the active construction, let us say my building construction is taking 3 years to construct, normally 3 years to construct. And in this situation, for 90 days, if it is normally suspended, let us say the construction is suspended because I'm doing some curing work, I'm doing some centering work, then it is not considered to be suspension. But if the active construction of the building has come to a stop, has got suspended for abnormal reasons, then for the period of abnormality, the interest which I was otherwise capitalizing has to be expensed. This is what borrowing cost says. So if the suspension of interest capitalization on capital work in progress during the lockdown period, should I do it? Should I not do it? Our institute came out with a guidance to say that if you can prove that this is a very small period, and during that period I was actually doing out some administrative and technical work in connection with that particular capital asset, then you may decide not to suspend capitalization. But while this could be a guidance, you cannot take that as a standard. I am sure that if no activity is being carried out during this suspended lockdown period, and this lockdown period is substantial in relation to the total duration, then I'm sure that this interest capitalization has to get suspended. What will be the impact in income tax on this matter? Income tax on Accounting Standard 16 equivalent, we have ICDS on borrowing cost. There they say whatever asset, be it a qualifying asset or otherwise, even if the asset takes only 7 months to construct, the borrowing cost in relation to a asset which has taken 7 months, in accounting, we will write it off as an expense. But in income tax, even if it is taking 7 months, they say it has to be capitalized till such time the asset is ready for use. Section 36, ICDS, all these sections go on to say that the borrowing cost in connection with an asset which is under construction has to be capitalized for income tax purpose until it is ready for use. So if, let us say in this context, if the active during the lockdown period for accounting purpose, I may suspend capitalization and debit it to my profit and loss account. But for income tax purpose, whatever interest is debited to my profit and loss account for income tax purpose has to be added back to the capital work in progress for income tax depreciation purpose, and only the future income tax depreciation can be claimed on this interest, but I cannot claim this interest itself as a expenditure for income tax purpose. Segment reporting, related party disclosures, leases, I don't see a big impact there unless it is leases of Ind AS types. Earning per share definitely would drop. That could be a collateral damage. Accounting for taxes on income, that is deferred taxes. There could be lot of impact. There could be lot of impact on the deferred tax calculation. Assuming that I have a deferred tax liability which I have to pay in future, on account of lot of losses on account of losses or expenses that I have to incur, I may have to, the deferred tax liability would automatically get reduced. So I may have a write back of deferred tax liability. Similarly, if I'm carrying a deferred tax asset in my books, because I have, I had huge unabsorbed losses, and I'm sure of making use of that losses by virtue of future profits. I had created deferred tax assets. This deferred tax asset will have to be immediately expensed out, because future also I may not have any profits against which I can make use of this deferred tax asset. So there could be an impact, both deferred tax liability and deferred tax assets. There could be impact in a big way during the financial year 1920. Discontinuing operations, lot of disclosures. If at all there is any segment which I am going to discontinue, I have to tell it in advance. So if I'm in the signing date, I am sure that 20 branches or a few of my segments are going to be wound up. I have to tell these are the segments which are going to be wound up, and also by virtue of accounting standard 24, tell the impact of such a winding up in the future earnings potential. Accounting standard 25, interim financial reporting, there could be lot of impacts. There could be lot of impact when I am actually drawing out the Q1 financials or Q2 financials. Accounting standard 29, provisions galore. There could be lot of provisions and contingent liabilities. Let us say I have taken up a contract which I am not able to fulfill, on account of which I have to pay damages. So those damages will have to be estimated and provided for in the financial year 1920 itself. Then if there are any onerous contracts could have automatically become onerous. What is an onerous contract? I am sure that I am going to get for a contract of, let us say, 10 crores. If the estimated expenditure is 8 crores, then 2 crores is a profit, no problem. But if I have taken a 10 crores contract, which I'm yet to do, look at this, if I'm yet to do, but I estimate that the cost of doing this contract now will be 11 crores. The cost of doing that contract, which I cannot go back, I have to do it, is 11 crores. So this 1 crore extra what I'm going to incur has to be provided for in the financial year 1920 as a onerous contract unavoidable cost. So as an unavoidable cost, I have to incur the loss that I'm going to incur in future on account of prudence. I have to book it in the financial year 1920. Such type of contracts are called onerous contract, and unfortunately, ICDS equivalent of this, provisions, contingent liability and contingent assets, does not allow this 1 crore debit what you have done in 1920. They will say you incur that, only then I will allow it. So that could be the issue there. So I have tried to list out all the accounting issue in one slide and tried to explain to the best of my knowledge. But if there are any questions, I can always take. I can see that there are a lot of questions coming through, but I will definitely answer all your questions. Be ready with your questions. You can post your questions at the end. I will take up questions one by one. So from the accounting field, I will get into the audit field. What are the changes in audit? Lot of changes. Audit risk gets multiplied in a situation when the times are uncertain. I may have to work out new key audit matters. From last year onward, we had a new standard called SA 701, by virtue of which I will have to do my audit. And if there are certain matters which have taken most of my time and I have most of my resources were deployed in reducing the audit risk on account of a particular matter, I will have to report in my audit report as to what are those matters on which I spent a lot of time, what are the risks, and how did I mitigate that particular risk with respect to an audit matter. So there could be a lot of key audit matters which could be getting reported during this particular 1920 audit report. So one of them I can say is inventories, normally net realizable value or revenue recognition. I would not have the matters with respect to valuations, matter with respect to cutoffs. I would not have spent more time in the normal situations. But if there are a lot of year-end transactions which have happened, I will have to spend more time to find out whether they were actually the turnover pertaining to 1920, or it should have been taken as 2020 turnover, and in 1920 I should have taken it as a stock. So I will have to spend more time in finding out the cutoff procedure. So therefore, I would consider that revenue recognition aspect as a key audit matter and tell how I have satisfied myself if I have to give a clean audit report with respect to that particular matter. So new key audit matter in response to additional audit work as a result of the outbreak. From last year onwards, the format of SA 700, 705, 706 got changed. And in the format change, they went on to say one thing, that if there is any uncertainty with respect to the going concern, if the issue is, I'm very sure that the going concern is impacted, then I tell the client, please redraw your financial statements as to realizable values. Get it down into realizable values. If he gets it down, there's no problem. If he says that, no, I am very sure that going concern is not impacted, but as an auditor, I am very sure that going concern is impacted, and he draws the financial statement as per historical cost, I will have to qualify that financial statement, saying that, in my opinion, the financial statements are not true and fair because it should have been prepared on a realizable value, whereas it is prepared on a going concern basis. That is a case of qualified. There could be another situation that there is an uncertainty with respect to going concern, but when I discussed with the client, he has convinced me as an auditor that there is no issue, there is an uncertainty, but we are sure that we will be able to overcome this uncertainty. In such situations, before last year, until financial year 17-18, we used to put a paragraph under emphasis of matter paragraph to say that there is an issue with respect to going concern. However, there is no problem. The company is confident of overcoming the concern, overcoming the uncertainty. Now, having said that, last year onwards, when the format got changed, they said that instead of putting it under the emphasis of matter paragraph, you shall come out with the separate paragraph before the emphasis of matter paragraph, with a separate heading itself called material uncertainty in relation to going concern. Mind you, this paragraph was told in the standard. This need not be there in every case. It has to be there only if needed. Only if the situation warrants it, you'll have to introduce this particular paragraph. Now, this year, I feel the need for introducing this paragraph in most of the concerns will be there, especially if the going concern is getting affected. We will have to bring in this particular paragraph under a separate paragraph and not under emphasis of matter. So where we'll say we'll put the heading as material uncertainty in relation to going concern, and we'll explain the situation and say how it is going to be met, and how it could go, how the risk would be mitigated. The third issue is, under the emphasis of matter paragraph, there could be lot of disclosures on account of significant uncertainty arising from the outbreak. When it is better that in all the audit reports we bring out a paragraph to say, we have the estimates which we have considered this year, the provisions which have been made this year is going to be significantly impacted on account of significant uncertainty arising from the outbreak. We don't know. We have assumed that all our customers will pay us, or all our inventories are net realizable value is intact as shown in the. What if it further goes down? So there could be significant uncertainty arising from the outbreak. We are not talking of going concern getting impacted. Some of the items or elements in the financial statements could be impacted on account of the significant uncertainty of the future. So we better bring out that in our emphasis the matter paragraph. And there could be a lot of qualifications or adverse opinion in respect of inadequate disclosures in the financial statement. There could be judgmental issues. There could be serious issues of disagreements between the auditor and the management, by virtue of which, because of the uncertainty involved, I as an auditor would take one stand, the company would take another stand. So therefore, the company would go ahead with the financial statements in the manner they feel is right, and I will have to only give my qualification or adverse opinion. There could be also issues with respect to internal financial reporting, internal financial control. Class companies have been asked, all companies have been asked to give a separate report on internal financial control. However, for private limited companies meeting certain threshold criteria, IFC is an exception. It need not be given. So, but for all other companies where IFC report is given, there should be additional procedures performed by the auditor, which I will tell you in a bit in the next slide. But one important thing I would like to pause and say here is today chartered accountants are allowed to sign not using a pen, but I mean not even use. Let me be very clean. A scanned signature cannot be attested on the financial statements. Today I have been allowed to use my DSC and put my electronic signature on the audit report. So if today's situation is such that the documents are coming to me for verification on the screen, and I am doing on my audit on the screen without the paperwork involved. So when the paper is not there, the pen is also not there. So the signature on the system can be done electronically. So on 13th of April 2020, our institute has validly allowed us to use electronic signature for signing all the audit reports and certification. I know that some of the companies particular advantage of putting their signature on the DSC mode. And very clearly in the announcement, the institute has told that ensure all other required compliances, all standards on auditing, etc., has to be complied with. All other announcements has to be completed with. And putting a DSC is also you have to obtain the UDIN before you put your DSC, or within 15 days from the time you put your DSC. So let's go to the impact on internal financial controls. What is this internal financial control? I have this explanation as to what an internal financial control is. We auditors were traditionally giving our audit report talking about the past. In the past, are there, in the financial statements which have been given, are there any mistakes or errors? So we used to comment and give our finding or a report that there were no errors, no mistakes, therefore the financial statements are true and fair. Or we used to say, subject to these two things, it is true and fair. That is the case of qualification. Now, I think 4 or 5 years ago, when the Companies Act 2013 came into picture, they said the auditor should report not only on the past financials, but also about the possibility of a mistake, mistake in future, on account of which the on account of failure, on account of not having proper internal financial control. So I am not only giving my report on the past, but also on the future weakness. If there are any material or a significant weakness in the company, because of various risks, there are certain weaknesses by virtue of which the future financial statements could get impacted. So that is what the internal controls not being okay. Then they said you make it into internal financial controls, and internal financial controls is a bigger subject for the board to decide. As far as the auditor is concerned, he will restrict himself only with respect to financial statements. So today we are commenting in the audit report, internal financial control with respect to financial statements. Are there any risks? Are the risks properly controlled? There are enough controls to control the risk, and are these controls effectively working? So I will have to look into all this in a parameter called the risk and control matrix. I will prepare a risk and control committee. Management would have prepared. I will do a control testing and see if all the risks have been properly mapped. So this is what I was doing till last year. Now, from this year onwards, I will have to see if there are any additional risks arising on account of COVID and lockdown. And I will have to see, on account of these risks, have new controls been put in place, or have they modified the existing controls? Now, one of the things could be, a lot of us are working from home. Now, when we are working from home, are the data which is going up and down properly protected? I mean, is there a security for the data which is going up and down? Are the proper controls in place for IT controls? Then, once the controls are there, are they working effectively? So, need to consider operating effectiveness of control. So, there could be the effectiveness of the control which was always there. Controls were always there. The effectiveness of those controls would have got reduced by virtue of, let us say, segregation of duties. Possibly if there are people sitting next to each other, they could have done proper segregation of duties. But today segregation of duties is not possible because one person is affected by corona, he is not at all there in his particular seat. Are the segregation of duties at stake? The lack of information could affect the management's ability to operate controls. But there could be employee absences because of which the effectiveness of the controls could get affected. And finally, the very financial statement methodology of preparing the financial statement itself would have undergone a change, because of which the risk of proper finalization of the financial statements would be at stake. So we have to see if all the controls are properly in place. If existing control cannot be performed, identify alternative appropriately designed controls to compensate for the lack of information. So this is very important. So internal financial controls, wherever we are giving the report, needs to be looked into from in a more involved manner. Okay? So that gets me to the end of accounting and audit matters. So now let me get into the company law, the corporate law issues, relief measures under the lockdown, and issues thereof. Kritika ji, are you there, and how's it going?
Yes, sir.
Yeah, it's okay.
Yes, sir.
For the record, let me tell you that I could see the chat box for a moment. I have two very important people who I have to recognize. Mr. R. Balakrishnan, the past president of the Chartered Accountants Institute. Sir, we are very glad to have you on the platform, sir. Unfortunately, I will not be able to see you, but it's a great honor for me.
He just messaged, sir. Congrats.
Yeah, I can see that. And I also have to recognize the presence of my good friend, Mr. C.N. Srinivasan, who was the past regional council member of SARC. I acknowledge their presence and move forward.
He also raised questions, sir.
Yes.
Yeah.
The next, let me get into the relief measures under the lockdown. I'll start off with the Insolvency and Bankruptcy Code 2016. For a company to trigger insolvency, the default criteria is 1 lakh rupees. If some company does not pay its financial creditor or operational creditor a sum of rupees 1 lakh and above, the person who is supposed to get the payment can write to the company saying that if you don't pay me this whatever dues to me, that is a cutoff of 1 lakh, I will apply for insolvency of your company. I can go to the insolvency, I can go to the NCLT and say that this company has not paid me, so therefore take it up for insolvency. Now this trigger of 1 lakh has been increased for this lockdown period, and for maybe they have just temporarily made this change. I don't know for how many days that is. They said that from 1 lakh, they have increased the threshold limit to 1 crore. So threshold of default to trigger insolvency under section 4 in the Insolvency and Bankruptcy Code increased to 1 crore rupees from the 1 lakh ceiling. So this is to prevent triggering of insolvency, because they're expecting that a lot of people will have liquidity issues, and 1 lakh is a smaller figure for anybody to approach for the closure of the company itself. Then this is yet to be passed. The finance minister has made in the press note, she has told this, but I'm sure there will be a amendment made in the IBC. What is that? They said that ordinance may be passed to suspend a fresh insolvency action. That means any insolvency action in the next 6 months, it could go beyond 1 crore also. That means for the moment they have taken it up to 1 crore, but in future, if they feel that the liquidity of the companies are so much impacted, the entire insolvency mechanism will be suspended for the next 6 months. That means no financial creditor, operational creditor, or the company itself can apply for insolvency. So they would like to suspend that. Next, one interesting announcement which already got made on 26th of April is that the lockdown period, see, for a resolution, for all the companies which are already in the insolvency mode, where the resolution mode or the insolvency mode, there are certain timelines specified. So for example, if the company's resolution professional has been appointed, within 330 days he has to complete the process, or he has to liquidate the company within 1 year. So what they have told is for 330 days, for 365 days cutoff period, they said this lockdown period will not be counted for timelines in insolvency or liquidation process. So that is the suspension of the lockdown period. One very important thing which they have done is the change in the FDI rules. The foreign direct investment rules have got changed to protect India from opportunistic takeover. I mean, on a very lighter note, I have put it there to ring fence our elephant from attack from the dragon. That is how the headlines of Economic Times went on that particular day. So I just tried to bring that here. So what they said is, if there is any direct investment coming in, it could be either of the automatic route or the approval route. There are certain sectors where the investment from abroad has to become in the automatic route, especially for defense and things like that. Let's not talk about that. But most of the investments which can come from abroad are under automatic route. However, what they did is, if the investments are coming from our neighboring countries, already Bangladesh and Pakistan was there in this list. Now they have added another 5 more countries. Interestingly, India shares its border with 7 countries: Bangladesh, Pakistan, Nepal, Myanmar, that is Burma, Bhutan, Afghanistan, and China. So there are the 7 countries with which India shares its borders. They said that from 17th April onwards, any investment coming from any of these 7 countries will have to be through an approval route. They have not banned the investment altogether. All that they have told is the investments will have to go through the approval route of the department. So that's how they have told. So, and not only the investments coming from these countries directly, but also the investments coming from these countries indirectly. That means if China is investing in a company in Australia, and the Australian company in turn invests in India, even that has to come through a approval route. So not only direct, but also indirect investments capturing the ultimate beneficial owner. So let me be very clear, there is no bar on FDI from China, only that it should be approved by the government before it is invested. So let me now come to the Companies Act in particular. What are the changes in Companies Act and the compliance requirement with respect to Companies Act? No additional fee charged for late filing of any company or LLP during the moratorium period from 1st April to 30th September 2020. This was initially made as a press announcement, and later on it came in as a circular called the Companies Fresh Start Scheme 2020 and the LLP Settlement Scheme 2020. 2 schemes they brought out. For companies, they brought in Companies Fresh Start Scheme 2020, and for non-companies, for LLPs, they brought in the LLP Settlement Scheme 2020. Let me read what the gist of both the schemes are. The gist of both the schemes are, it permits filing of all pending returns, statements, documents for any number of years. For any number of years, what it could be from 1956 to 2013 to date. In fact, it's very interesting. Applies to all companies, both public or private, incorporated under Companies Act 1956 or 2013. If any of the returns under the Companies Act, any of the documents have not been filed, you can file it today without paying 1 rupee of additional fee. You'll have to pay the normal filing fee although. When is the scheme opened up? This scheme was opened up from 1st of April 2020 and gets over on 30th of September 2020. Only normal fees is payable, no additional fee payable. Immunity from prosecution or imposing penalty provided to the extent of delayed filing. So on account of delayed filing, immunity will be provided. But one important thing which I've given in red is no immunity against any punitive action. No immunity against any punitive action for which suitable actions can be taken. For example, now we know that a company whose paid up capital is more than 10 crores has to appoint a company secretary, has to appoint a full-time company secretary. Now, if this company had not appointed a company secretary for the last 4 years, let us say the company in 2016 paid up capital was 10 crores or it went beyond 10 crores. So it should have appointed the company secretary in 2016 itself. However, 16, 17, 18, they did not apply. In 2019, they appointed a company secretary. and they just kept quiet. They did not file DIR 12. After appointing a full-time company secretary, the company is supposed to file a document called DIR 12 with the ROC. Now they had not filed this. So there are two things. So the ROC could have charged a penalty for not appointing the company secretary for the first 3 years. And the company should have paid additional filing fee for not filing this DIR 12 on time. So this scheme permits you to now file whatever you did not file last year, DIR 12, you file it now. But for this scheme, I would have paid a filing fee with additional filing fee. Now they say you don't have to pay the additional filing fee. I will not charge you a penalty for not filing this particular form for the last 1 year. However, the penalty with respect to not appointing the company secretary for 3 years, I will definitely levy. So there is no immunity from any punitive action for which suitable action can be taken. So that is what is told there. Application. So let us say if you filed any document under this scheme, once the scheme comes to an end, you shall file in form, after you file a particular form, let us say in this case DIR 12 you filed now, and after the closure of the scheme, you shall also file another form called Form CFSS 2020 for obtaining a immunity from future penalty or prosecution. So when should it be filed? After closure of the scheme and after the documents are taken on record or approved by the ROC before 6 months from the date of they have given the timelines. Which are all the forms which can be filed? Any form excepting these forms. This CFSS scheme will apply to all forms but shall not apply to form for increase in authorized share capital, that is SH7. Charge related documents. Charge related documents, that is CHG1, CHG4, that is satisfaction of charges, CHG8 and 9. So these forms cannot be filed under this particular scheme. Cases requiring condonation of delay. If there are any forms which can be filed with the approval of the ROC, you will have to first get the condonation of the condonation from the ROC, and then after he condones it, you can come and file this without additional filing fees. And companies against whom final notice under section 248 for strike off has been given by the ROC, or who applied for strike off or applied for being declared dormant or to vanishing companies, or companies which have amalgamated under a scheme. That means where these particular points are very important. If a strike off notice has been given under section 248, I will talk about 248 when I come to issues. So when this is done, companies strike off issues, companies applied voluntarily for strike off, company declared as dormant, company is considered to be a vanishing company, and companies which have amalgamated under a scheme of arrangement or compromise, for these companies, the additional filing fee scheme, the waiver of additional filing scheme, CFSS, is not applicable. So companies can avail the scheme for applying simultaneously for getting themselves declared as dormant under section 455, or they can apply for striking off the name of the company by filing STK2. That has also been told. So let me tell you, this is a very good scheme for those who have not filed some or any of the forms. You can file this. This scheme, let me tell you, is not normally the various incentives which have been given now. Not the reliefs which have been given now is only for this lockdown period, but this scheme goes much before the lockdown scheme. In fact, it goes from 1956. 1918 pandemic cases which have not been filed also could be filed at this point in time. So this is a golden opportunity. Let me also tell you, below I have written that there is a requirement for every director to file a DIR 3 KYC. If he has not filed DIR 3 KYC from last year, it got introduced. If he has not filed, there was a penalty that was required to be paid beyond the filing date. So he should have beyond that, it could be filed only by paying 5,000 rupees fees. So this fee is also waived. So DIR 3 KYC, whichever director has not filed by virtue of his is marked as deactivated, he can file it now without the additional fee of 5,000 rupees, provided he files between 1st of April to 30th of September. Last year, there was additional requirement of filing. Every company had to file INC 22A. that was called as active form. It's called technically we used to call it as active form. Every company incorporated after I think 1st October 2018 or so, that there was a cutoff there. So they were required to file an active INC 22A form. And if they had not filed it within the cutoff date, they could file it. They would be called as active non-compliant. They would not have been struck off, but they would have called as active non-compliant. And beyond that date, they could comply it by filing INC 22A with a 10,000 rupees penalty. So now under this scheme, you can file. If you have not filed then, you can file it now, and you don't even have to pay the 10,000 rupees additional filing fee. I was talking about those forms which require condonation of delay. Not every form can be automatically filed. Now, condonation of delay is told in section 460. Delay in making any application to central government within the time the government may condone. Delay in filing any document with ROC within the time central government may condone. So they have delegated the powers to ROC and RD respectively. Now, having said that, what are the popular cases? If I have not held the AGM on time, I mean, this could be a very popular one. Why I say is, after the introduction of UDIN, earlier some of the company used to backdate and sign. Now there is no possibility of doing that. So if there is any default in holding AGM, the auditor has to sign on a particular date, and UDIN has to be generated. So in case there is a delay, he has to get a condonation first, and then only he can file the relevant forms. So like that, the popular cases I have listed where condonation of delay is required from the central government: delay in filing e-forms like NGT 14, failure to appoint KMP, creation or satisfaction of charges, and filing of INC 20A. I will talk about what is INC 20A a bit later. One very good thing which has happened is CARO 2020, which was a big, which involved a big work for the chartered accountants and the companies, got postponed by 1 year. I mean, I always, on a very lighter note, keep telling that we have the MCA took a leniency on the chartered accountant, saying that you are facing COVID-19, so we'll defer CARO 2020 for next year. So we had a situation of COVID-19 versus CARO 20. So CARO 20 has been deferred. Otherwise, there are a lot of questions. 16-point program became a 21-point program in CARO 2020. This 21 points had actually 48 sub-questions. So we had to answer 48 questions. Some of the questions were very, very difficult for us to answer. One of the questions which was so difficult was whether the company is capable of meeting its liability existing at the balance sheet as and when they fall due within a period of 1 year from the balance sheet date. So this was the question which was required to be answered by us. We would have put our fingers crossed on if this were to be there. So uncertain that is. Whether the company is capable of meeting its liability, that means the term loan dues, the creditors payment, etc., as and when they fall due within a period of 1 year from the balance sheet date. I mean, we used to say this whenever I used to talk on this. I used to say auditor also had to be an astrologer to answer this particular question. Thankfully, this CARO 2020 has been deferred, but we have to comply with CARO 2016. The next point is on CSR COVID-19. Let me tell you here that funds spent for various activities related to COVID-19, if the company is doing some healthcare promotion, is feeding the poor, or doing some sanitation work, or is doing some disaster management, all these are covered for CSR activity. Let me tell you, section 135 of the Companies Act tells that every company which has a turnover of more than 1,000 crores, a net worth of more than 500 crores, or a net profit of more than 5 crores has to spend 2% of its net profits towards the CSR. So I call this as class companies. So this class company has to spend 2% of its net profit towards CSR activity. Now, any amount spent under these headings directly by the company will definitely be considered as CSR activity. Now, second thing what they have told is any contribution to the PM CARES fund. So just like Prime Minister's National Relief Fund, they have set up a special fund to meet this particular eventuality. The Prime Minister's CARES fund, which has been set up, any contribution done to them will also be considered as spent towards the CSR. The best part about this is not only it gets covered under CSR, you also get a benefit under 80G for Income Tax Act. Now, let me tell you, if the company is directly spending its money towards any of its activities, it will be debited to profit and loss account as expenditure towards CSR, and it cannot be claimed under Section 37 of the Income Tax Act. Income Tax Act under Section 37 very clearly says that any expenditure which is spent to meet its CSR obligation will not be allowed for income tax purposes. However, any contribution which is done towards the PM CARES, or for that matter PM National Relief Fund, can be claimed as a 100% deduction under Section 80G of the Income Tax Act. This is a very interesting thing. If more than 2% of the prescribed CSR expenditure is spent, it may offset against the CSR obligation of the subsequent years. Now, this came in on the home page of the MCA website. But if you look into the legal requirement, nowhere this legal requirement is there as a circular or notification or in the rules or in the act. Now, what is this coming out of? I'll have to tell you what CSR changes are likely to happen. Companies Amendment Act 2020 is going to happen. The bill is already in the parliament. It has been cleared by the cabinet. And one of the conditions that they say is that whatever surplus spent under CSR can be adjusted against the next year. So they have taken from the amendment bill, which is likely to be passed in 2020 itself, to say that whatever surplus CSR spent for a particular year can be adjusted and carried forward for the next year. Let me tell you in simple terms. Suppose I have an obligation. I had 100 crores profit and I had to spend 2 crores towards the CSR. And this year, because of the extraordinary situation, I gave 3 crores as donation to PM's CARES funds. So what I can do is, this 1 crore extra what I have spent, I can adjust it against my CSR obligation of next year. Where is it coming from? It is coming from the Companies Amendment Bill 2020, which is placed before the Parliament, and they are expecting that it will be cleared in this particular, when the Parliament sits next. Let me also tell you one very interesting thing on CSR. I will have to tell you one very important thing. CSR section 135 talks like this. What happens if a company does not spend its CSR? Let us say 2 crores it had to spend. It has spent only 50 lakh rupees. What is the implication on the auditor or on the company? Now, for the moment, section 135 subsection 5 says, if the company fails to spend the 2%, board shall in its report specify reasons for not spending. That's it. For the moment, the obligation is to spend or to report in the director's report. So if I have spent only 50 lakhs as against 2 crores, I just have to say that 1.5 crores I have not spent because I have liquidity problems or whatever whatever reason I want to say. However, section 135 subsection 5 also has got certain wordings which is still not notified, certain provisions which is still not notified. What is this further wordings in red there? And unless unspent amount relates to any ongoing project, transfer such unspent amount to funds specified in Schedule 7 within 6 months from the end of the financial year. That means if I have spent 50 lakhs against my obligation of 2 crores, this 1.5 crores, I will have to decide, is there an ongoing project? If there is an ongoing project, then I have to put it into a separate account by virtue of section 135(6). I have to put it into a separate bank account like the unpaid dividend account, and I have got right to spend this in the next 3 years. Okay. If I don't spend it in the next 3 years, then within 30 days from the end of 3 years, I have to transfer it to a government account. Now coming back, if I don't have an ongoing project and I have spent only 50 lakhs, this 1.5 crores has to be transferred to a fund account which is specified under Schedule 7. They have not still specified. It will be similar to IEPF fund. Just like an IEPF fund where unclaimed dividends gets transferred to IEPF fund, like that unspent CSR amount will have to be transferred to a government fund account from which the government will spend towards CSR activity. So that particular provision is still not notified. So that is why I'm saying Today, if you spend only 50 lakhs or you spend 3 crores, you don't have a big problem. So therefore, they said that we will introduce the concept of carry forward in the next bill, so that when you have spent more in a particular year, in the next year, you can say that I have already spent it last year. Say this year obligation was 2 crores, I spent 3 crores. Next year obligation is 2.5 crores. 2.5 crores. Then I may say that I had spent 1 crore extra in this year. So next year I have to spend only 1.5 crores. So therefore, I may not have to transfer. If I have spent 1.5 crores, I don't have to transfer anything to the government fund. So that is the scheme which is coming into picture. One of the changes which has also happened in the amendment bill, which is placed before the parliament, is they have changed the penal provisions, which is still not notified. Before notification itself, this provision gets deleted and the new provision comes into place. The provision said that in case you don't transfer this and you don't spend this, the company will be liable with some penalty, but the officer in default was punishable with imprisonment. So that they have removed, and in the bill, they have introduced a concept of punishing the company with 200% of the amount not so transferred, or rupees 1 crore, whichever is less, and the officer in default with 10% of the amount not so transferred, or rupees 2 crores, whichever is less. So CSR we have understood. So newly incorporated company requires to file declaration for commencement of business in INC 20A. So whenever a company is incorporated, within 180 days, it should collect the promised subscribed capital from the subscribers, and immediately thereafter file a form INC 20A with the ROC, saying that my company is up and running now. Otherwise, it could be a ground for strike off from the ROC. The implication is so huge. So now that we have some starting problem, so they have given additional 180 days, additional 6 months to file this INC 20A, additional 6 months to collect the capital. So totally from the date of incorporation, you have got 12 months time to get the capital and file the INC 20A. The creation of deposit reserve and 15% debentures, wherever they are deposits and debentures, they have given additional timelines. The mandatory requirement of holding board meetings within the prescribed interval period, maximum 120. Now, is there a time limit by which the board meetings have to be conducted? Section 173 of the Companies Act only tells that there shall be 4 board meetings in every company. It doesn't say when and what and all those stuff. It says there shall be 4 board meetings held by every company, and the gap between 2 board meetings shall not be more than 120 days. Now, this situation, because of the lockdown, they have told that up to 30th September 2020, the gap can be up to a maximum of 180 days. They have given additional 60 days gap between 2 board meetings. Next, board meetings through video conferencing. Should board meetings be physically conducted? The answer is no. It can be done through a video conferencing, was always told. However, for the following 5 activities, for the following 5 approvals, the board had to physically meet, and only then the board proceedings could have been recorded. So what are the 5 activities? Approval of financial statements, approval of board report, approval of prospectus, approval of audit committee meetings for consideration of financial statements, and approval of M&As. So these 5 items, agenda items, had to be approved only in a physical board meeting. However, they have now told if there is any meeting held between 19th March to 30th of June, even that can be held through a video conferencing mode. We also know that every company, there should be at least 1 director. I started off with the women director. Now I'm saying there is a requirement that at least 1 director under section 149 should be a resident of India, staying in India for 182 days, minimum of 182 days. So that they have given leniency for the financial year 1920. In fact, they should also give the lenience for 2021. That could also be coming through. So requirement of independent directors, wherever there are certain class companies where independent directors are required, and in such companies, there is a requirement that only independent directors should meet without the presence of the non-independent directors and management. At least one meeting they should hold is what was required. So that requirement has been dispensed with for financial year 1920. EGMs can be conducted on or before 30th June through video conferencing. Very interesting. EGMs should always be held physically, or general body meetings should always be held physically, but an option should be given for people to come and do the electronic voting. That was there, postal ballot and things like that. But now they said the EGM itself can be conducted through a video conferencing mode. That means the chairman can be sitting somewhere, the general managers, the directors can be sitting in different places, and the EGM can be held the manner that we are holding the webinar now. So like that can be conducted through video conferencing or other audio visual mode. So that is a exception which has been carved out up to June 30th, 2020. And they have also given certain relaxation for conducting AGMs by companies whose year ending falls on 31/12/2019. Since it's an exception, I will not explain. They've also given an extension of the time for names reserved and for resubmission. If anybody has applied for a name or any document has been filed and it has come for resubmission, and the last date happens to be between 15th March to 3rd of May, that is during the lockdown period, they have told that we will give additional 20 days for name clearance and additional 15 days for resubmission. So I have given you the dates. So as promised, I will share this PPT with the branch, and the branch will either upload it on its website or will mail it to all those who have asked for it. Okay? So non-availability of MCA 21. I mean, this is a small point. Those of you who are regularly dealing with the ROC matters, they need to know that if they raise any ticket with the help desk or they want any voice call from the help desk, they are not working. The help desk itself is not working, is what is put up on the MCA website till further notice. I come to some of the issues. I completed my presentation, but I will take up a few issues on my own before I get into the issues which you people will post. Kritika ji, can I take 10 minutes more before I come to the questions of the branch, or you want me to ask the branch? Two ways I can.
No, sir, you can go again, sir, from your issues.
Okay, I'll just quickly go against my prepared issues. In fact, let me also tell you that these issues in Bangalore, Karnataka State Chartered Accountants Association had issued a survey questionnaire, and a lot of issues came out from various members of Karnataka and other places. So these are the issues which I had actually addressed the Karnataka State Chartered Accountants sometime back, last week actually, wherein these issues were answered. So I thought these are very good issues, and I will raise those issues before you quickly and answer them. Can a company to whom notice under section 248(1) of the Companies Act 13 apply under the Companies Fresh Start Scheme? What is this 248(1)? Very important for us to know that a company which has failed to commence its business within 1 year from the date of incorporation, or has not carried on any business operation for 2 years immediately preceding previous financial year. In the first instance, company was incorporated in 2019. Up to 2020 or the same date, they did not start any activity, so it could be a ground for strike-off. Second thing, company was incorporated in 1990, and in 2000, from 2018 to 2020, no activity has been carried out. So not carrying on any activity for last 2 previous years. Subscribers to memorandum not paid subscription amount within 180 days. We already saw the section 10A of the Companies Act wants every company to pay up its paid up capital within 180 days, now extended by another 180 days, and file the form INC 20A. If this is not filed, it could be a ground for strike-off. And company not carrying on any business or operation as revealed after the physical verification is carried out under section 12 of section 9. If the ROC carries out the physical verification and finds that there is no activity, he can strike off the company. So there, suo motu by the company can apply for strike-off, or the worst situation is the ROC can, by giving an STK 1 notice, ask for a show cause as to why you should not be struck off. If you give a reply suitable, it's okay. If you don't give a suitable reply or if you don't give a reply at all, the ROC will give it out in a newspaper advertisement saying that I will issue an STK5 newspaper advertisement saying that these are the companies which are about to be struck off. Is there any objection from an outsider? It could be from the income tax department or anybody. If they have objection, they will write. If nobody objects, then the ROC will strike off issuing a notice under STK 7. So the point I'm saying is, can a company to whom notice under 241, the strike off notice has been issued, apply under the scheme? The answer is no. How to calculate the fee under CFSS 2020? If we try to calculate the fee with the SIN number, it shows normal fee and additional filing fee. So there is one enquire fee mode in the ROC website where you can go and ask how much fee is likely to be charged. If you use that, it will not know whether it is under CFSS or normal. It will show normal additional filing fee. So please understand that if you are filing any form other than the exceptional form which I told, there will be no additional filing fee in spite of the enquiry fee in the website showing additional filing. When you actually file it, there will be no additional filing fee. Whether this scheme applies for regularization of directorship. So what do you mean by regularization of directorship? Regularization of directorship means if the director has been disqualified under section 164, especially under section 2, where the company has not filed its annual returns and financial statements for 3 years, the director stands disqualified for 5 years. That is one of the disqualifications. That he cannot be regularized by filing a CFSS. Let us be very clear. But having said that, what is meant by regularization? There could be another thing where a director is appointed in a board. So the first director is appointed in the board, he is called as an additional director, and his additional directorship has to be regularized in an AGM. The AGM should regularize his appointment. In that context, that is called as a regularization. So the moment you appoint him as a director in the board, you will have to file a DIR 12. Again, you will have to file a DIR 12 when you regularize his appointment in the AGM. Okay. In both these contexts, if DIR 12 has not been filed, then you can come under this particular scheme. Can this be used for filing belated charge forms also? The answer is no. Not only the charge forms, the satisfaction forms also cannot be filed under this particular scheme. Is this scheme applicable only to companies who are still live on MCA system? If it is a case of active, if the company is active, I told you, if the company is struck off or a notice for strike off has been given, this scheme is not applicable. If the company is active non-compliant by not filing the IMC 22A, then you will have to file first IMC 22A, make it active compliant, and then file any of the other CFSs. Even for filing IMC 22A, there is no 10,000 rupees penalty. Please clarify till what date this is applicable. Up to 30th September. Can a company which is registered in 2019 and has not filed any forms till now make use of the scheme? If so, what are the implications? If the company is incorporated in 2019, not many returns will be required unless there are any activity-based returns, like increase in authorized share capital, then not possible. Director's appointment, yes, possible. So, whatever, an annual return and MGTs, you still have time, so there's no problem. You can still file, not only 2019, if it is a company incorporated in 1919 also, you can still file a form under this particular scheme. LLP settlement scheme is a new scheme wherein all the forms under LLP which has not been filed since inception to date can be filed. And there is no, in fact, initially when the LLP settlement scheme said, they said 10 rupees additional filing fee has to be filed up to a maximum of 5,000 rupees, and the scheme was supposed to start in March and end in June. This they have revised to say that no additional fee whatsoever, and the scheme is available now up to 30th of September 2020. The question here is, in case a concern has not got the audit for the past 4 years and has not filed returns, in such cases, what is the remedy available? First thing is you have to get the audit done if it is required to be audited. Not every LLP is required to be audited. LLP is required to be audited under the LLP Act under 3 situations. One, if the turnover of the LLP is more than 40 lakhs, the contribution by the partners is more than 25 lakhs, and if the partners voluntarily ask for an audit. In these 3 situations, audit is a must. And if audit is a must and if it has not happened for the last 4 years, first the LLP should get it audited. The auditor should use the current date, especially because of the DIN issues and all the student issues. You have to be very careful about that and file the return. For filing that, there will be no additional filing fee. But there could be a penalty charged by the ROC for not filing, for not carrying on the audit on time. That could be a different issue. LLP is a very good opportunity, so please file, because earlier, if there was any default, we had paid so many LLP forms, 30,000, 40,000 additional filing fee. When the filing fee was only 100 rupees or 250 rupees, the additional filing fee was 30,000 rupees. And some cases where we said 30,000 rupees, the additional filing fee, the promoter went back and came back after 1 week with 30,000 rupees. He said now it is 30,700 rupees. Then every day the meter used to go up by 100 rupees. So that is a very good scheme. So please tell all your clients to file if they have not filed. Annual returns and MCA filings for MCA 1920. Company has delayed collection of paid up capital and also as a result has delayed filing of Form 20A. What are the consequences? We have already seen. Filing. So this INC 20A to be filed within 180 days has been further extended for 180 days. Is it applicable to all companies whether incorporated in 2019 or 2020? Let me tell you, 180 days and 180 days makes it 360 days. In fact, 360 days before, if you have incorporated the company, you can take advantage of this particular scheme. Beyond that, you will be under the red zone. For companies incorporated in January to March 20, when they need to file NGT 7 and AOC 4. This is a very good question. If a company is incorporated between January to March 2020, the filing will happen based on their AGM date. And in the AGM, they have to approve the financial statement. The financial statements for a company which is incorporated from January to March will have to be necessarily next March. Section 2, subsection 41 of the Companies Act tells a financial year for a company is starting from April to March, compulsorily. However, if it is a company which is incorporated between January to March, then its financial year will start from the date of incorporation and end with the March of the next financial year. So let us say that it was started on January 10th, 2020. The financial statement will be from 10th January to 31st March 2021. And when they need to file the MGT 7, normally the AGM should be conducted within 6 months from the date of end of the financial year. But for the first AGM, they have given 9 months time from the date of the year end. 9 months from the date of year end. So for a first AGM, they can go up to 31st December 2021. So from there, 1 month for AOC 4 and 2 months for 60 days for MGT 7. Whether ADT 1 is to be filed mandatorily for the first auditor, the first auditor who is appointed by the board, failing which by the AGM, normally it gets appointed in the board, need not file ADT 1. ADT 1 is required to be filed if he is appointed by the AGM for subsequent audit. Form 22A, should it be filed every year? So Form 22A, just now I told you, IMC 22A, which is to be filed by a company, one time to make it active. So this need not be filed every year. If at all you have not filed IMC 22A and your company status is sold as active non-compliant, then only you have to file. Is it mandatory for a company to file nil Ben 2, where there are no SBO? What is this SBO? Significant beneficial ownership. Where a person is registered owner, a person is holding more than 10%, not being an individual, then we'll have to find out who is the individual, and in that context, more than 10% who is holding has to issue Ben 1 to the company, and the company has to file Ben 2. I'm not getting into the details of that. So, but if the company has not received Ben 1, there is no need for the company to file Ben 2 with the ROC. So a company does not have to get into if it is not applicable cases. CSR we have already dealt with, but let me just quickly go through. CSR spending after 31st of March 2020 eligible for 1920. Yes. Income tax has told that anything which you have spent after 20th March to 29th of June can be reckoned for as though it has been spent in the previous year. So between 20th March to 31st of March, if you say that you have spent in this year, you can take the benefit under income tax in the last year. But for accounting, if you have made a provision for last year, you take it in the last year. Otherwise, for accounting purpose, it will be done in this year itself. So whether contributions made to CM and PM relief funds are considered as CSR activity. And one point to be noted here is both the CM and PM relief funds are eligible for 80G deductions, but when it comes to CSR activity, contribution to Prime Minister's Relief Fund alone is allowed for CSR activity. Any contribution to CM Relief Fund is not allowed for CSR activity. Where funds are available to the company but has not spent and deferred, any impact on the audit, I just now told you, 135(2) for the moment, since it is not notified, if the company has not spent it, there is no implication on the auditor. Later on, once that 135(2), the red point gets notified, if the company does not take action, I am afraid we will have to bring on those points in our audit report in case it is not transferred to IPF equivalent fund. Can donations made to Goshalas be treated as CSR activity by a limited company? The answer is animal relief. Any amount spent towards animal relief is also considered as CSR activity. So Goshala, if it is spent towards Gomata, definitely it is an animal relief. But points to be noted is if the Goshala is run by the company, no problem, it can be spent. If it is run by a Section 8 company or a trust or a society which is registered and set up by the company or the group of companies, set up a group of companies together, then no problem. If it is a Section 8 company or a registered trust or a registered organization which has more than 3 years track record, then there is no problem. Otherwise, if you are giving it to somebody else outsider, then you have a problem if they are not registered, not a Section 8 company. So please take care of all this. The CSR tax activity, board meetings, we have discussed enough. I think I've already covered this. Any other issues? Let me just finish off your issues and then I will come back to. I think I've already completed my time. I will 6:30 it is. So let me ask if there are any questions from your side. Then I will come back to my questions pending time.
Yes, sir. Few questions were asked by the members.
Yeah. Can you please post the questions? I will.
Yeah. Yes, sir.
Yes, please.
Did you able to see the query, sir?
No, you will have to put up the query, please. Yeah, no.
No, it was fixed. Yeah.
Yeah, I am able to see that now. Srinivasan sir, good friend of mine. I am the past regional counsel, as I told you. Some clarity on COVID impact on cash flow accounting standard 3, please. Sir, the financial cash flow statement is a derivative. It gets derived from the financial statements. It does not have an independent existence. So whatever happens to the balance sheet and the profit and loss account, Kritika ji, you have to mute your, just mute, please. Yeah. Whatever happens to the financial statement, that is the balance sheet and profit and loss account, the derivative gets accordingly impacted. So therefore, I told in my presentation that cash flow will not be, definitely there will be a liquidity issue, but that liquidity issue will be reflected first of all in the balance sheet and the profit and loss account, and thereby will be collaterally impacted or reflected in the cash flow statement. So it will not be a direct impact, it will be a derivative impact in that sense. Next, please. Next question. For 1920, mere mention of unspent CSR in the board report is okay. For 1920, very clearly, if you have mentioned it in the board report, it is sufficient. So auditor does not have a role. So till now, since that particular 135, 5 and 6 in the red, what I showed in my presentation is not yet notified, it is still going with the original thinking of spend or report. If you spend, there is no problem. Otherwise, you have to report. Report means only in the board report. So therefore, an auditor does not have a role to play in that context. You are right, sir. Please explain timelines in insolvency again. Now, I also told you that once a company is taken up for insolvency, within 330 days, it has they resolve. In fact, initially it was 270, then they increased it by another 60 days. within 330 days from the time it is taken up by the resolution professional, it has to be resolved, failing which within 1 year the company has to be wound up. So that for the moment, these 330 days and 1 year, the lockdown period will not be counted. Let us say by virtue of this 45 days of lockdown, this 330 days has happened, means 330 minus 45 days will be the way which has to be calculated. Sir, my query is a general one and not related to COVID issues. What's the accounting treatment for advisory shares issued by a private limited company? Can we talk separately, please? I don't understand what is the question. Advisory shares. Advisory shares, I don't understand what is the question. Is it something like a share that he is talking of? I don't know. So I need more clarity on the question to answer this. So next question, please. The company has got for a private placement a month prior to this advisory issue, where it was issued at a premium. Again, next question, please. I don't understand what is this advisory issue. Manoj Kumar has to write to me separately. I will answer him separately, please. Next. $1920 will be impacted due to subsequent events. Definitely, yes. I think it is more a statement than a question there. Financial year 1920 will be impacted, certainly, as I told you in the beginning, sir, because of subsequent events. Yeah. Next, please.
So these are the questions was raised by the members, sir.
Sure. Yeah, I think
one more question.
Yeah, please.
One more question from my side, sir.
Yes,
give some disclosure of contingent liability in general. If there is a general disclosure should be given by each company.
Certainly, yes. So there could be some contingent liabilities also. Let us put it like this. There could be some damages which I may have to pay, or delay in payment, which I am not very clear. There could be some liquidity damages which I may have to pay, but we are not very sure that the customer may not ask of cases. Okay. Then there could be an issue of disclosure in as a contingent liability rather than as a creation of a provision. So if provision is not made, contingent liability at least will have to be made for all cases where there is a possibility of cash outflow.
Thank you, sir.
Thank you, madam. So I can only wind up. No, can I just give my concluding remarks, please?
Yeah, yes, sir.
I think I have to share the screen once more, or is it visible?
It's not visible, sir. You want to share once again?
Yeah, I have to share once again. So I can only thank Pondicherry branch and Madurai branch for keeping me active during this lockdown period. And I enjoyed talking to you and enriching my knowledge. But I can only say before I close that I started off with the VUCA. I have to end with the VUCA, saying that we chartered accountants can certainly overcome this situation with proper vision, understanding, clarity, and agility. And we and you, being CAs, can certainly deal with this situation better. So this word VUCA has a CA in it, so beautifully tucked in there. So we can deal with the situation better. But please take care. Don't read negative news. Think positive, and we will definitely be coming out as winners. Thank you so much. Over to the organizers, please.
Thank you, sir. Thank you for a detailed explanation, and also with reference to each accounting standard, and also with reference to COVID. A special thanks to clarify all the queries which was raised during the webinar. Now I request the Secretary of Madurai branch to give a vote of thanks.
Respected Chairperson of Pondicherry, CA P. Kritika. Respected Chairperson of Madurai, CA A.K. Abhinay. Respected Guest of Honor, SARC Chairman, CA D.C. Jain. Respected Speaker, CA K.G. Acharya from Bengaluru. Respected Secretary of Pondicherry branch, CA Sajesh Kumar. Respected Management Committee members of Pondicherry branch. Respected Management Committee members of Madurai branch. respected senior members, fellow members, and junior members of Pondicherry, Madurai, and all over India. Greetings to all. On behalf of Management Committee of both Pondicherry and Madurai branch, we thank the speaker who accept our invitation and deliver a detailed, informative class-by-class presentation on COVID-19 issues on Companies Act, accounts, and audit. We are enriched by your meticulous, lucid explanation, sir. It is very useful to the members, and we thank you once again, sir. We thank the chairpersons of Pondicherry and Madurai branch for effective coordination to conduct this webinar meeting. Thank you all the members of Pondicherry branch and Madurai branch who attend this program. Thank you all other members who view this program. Thank you, one and all.
Thank you.
Thank you, sir.
Thank you, sir.
Thank you.